Hey everyone, I want to do a quick video about Lemonade's Q1 earnings, which are coming up this Tuesday/Wednesday, so a couple days away. And so I want to just run through, again, my numbers, not get too deep into all the assumptions around it, but show you sort of the high level numbers and what else we can expect for these earnings or some things to be watching for, thinking about. So first of all, what are we expecting numbers-wise for Q1? Yumi had this great post in the Lemonade community group on X, on Twitter. He said, hey, there's a consensus estimate rating ranges for Lemonade. And the consensus was from analysts 791 million IFP, 78% gross loss ratio, $41 million adjusted EBITDA loss. So, and you can kind of see the breakdown here. You can get more detailed, but some rough numbers there. It's interesting. They're with an average of 791 million IFP. If you look at Lemonade's guidance, they have a range of 789 to 791. So it's almost like analysts are just kind of plugging in or predicting that top number. But Lemonade has, if you follow this company at all, has a history of consistently beating their own guidance. So my guess is going to be higher than 791, which I'll break down a little bit more in this video. And they had adjusted EBITDA loss of minus 43 to minus 41, that range. So jumping over to my own model, I had done this in a previous video where I looked across all of 2024, but we'll just focus on Q1 for this video. So for customer count, here's kind of just some quick summary. Customer count, I'm expecting in Q1 you get about 2,160,000 customers. That's assuming, hey, they acquire about 1 million customers over the entire year. And that's based on in their Q4 letter, they said they're going to double their customer acquisition spend this year to about 110 million. And from previous quarters, followed my channel at all, I have calculated the customer acquisition cost per customer. I'm going with about $110 per customer this year. So then that works out. If you're spending 110 million over the year, and the average over the whole year is $110 per customer, on average, across the whole, you're going to have about 1 million customers come in the door. So Q3 is usually the biggest. That's why I have more there. But the other quarters, I'm roughly expecting, hey, they're going to add about 200 and some thousand customers per quarter based on that. And then you think about the whole pool of customers is churning away. About 17% of customers, I have that calculated as well, churning away. You get to an end result here. I'll pop it up here. Here is your initial customer count. You had that many, you churn a certain amount, and then you add 200,000, some more. You get 2.16 million customers. So that's where I'm getting 2.16 million customers. Then my IFP, I have 812 is sort of what I'm thinking, somewhere in that range. I think if they do that, it's going to be that'd be a nice little surprise. I'm not sure how the stock will react, but I think that would be a nice little surprise if they get over 800 for sure, and especially if they're over 810, maybe in the 812 kind of range. And how did I get to 812? Well, I'm thinking about it like they had 748 ending last year, and then Q1, I'm assuming about 25 million adds in just from rate increases. And then home non-renewals, so they're canceling home customers that they don't want to wait for regulators to approve price increases for those rates. They're ditching customers. I talked about that with Daniel in my recent interview with him. If you haven't seen that interview, you can find it on my channel. I'll link it up above here. And then I'm assuming, hey, the new customers coming in the door are still going to be more slanted towards renters and pet insurance, so they're going to have a lower premium per customer than the overall average. I have some calculations for that, but I'm saying, hey, new customers coming in the door are $294 per customer. This is going to change. This number, say next year, 2025, is not going to be $294. It might be even like $400 or something like that, $450, because we're going to have a lot more home customers, car customers at that time who will be coming in the door. But right now, $294 is what I'm thinking and calculating. So, of course, these are all just estimates. There's a lot you have to sort of assume and guess work and read between the lines and pull as much little detail as you can, but that's what I'm thinking. And then 2%, this is what I'm calling a premium per customer growth from cross-sell. So naturally, the whole group of customers has this bundling effect where we're inside of a customer, whole pool of customers, the 2 million and some customers they have, they're naturally upselling to more products. They get another pet, they buy a bigger house, they get another car, they have renter's insurance, and then they buy a house and they have home insurance, et cetera, et cetera. So all that combines, that along with, again, I'm saying a customer churn of about 16.8% over 12 months. And the calculation then, just to show you that one, you have a certain amount you're starting with, you add 25 million from rate increases, you subtract 4 for home non-renewals, and then new customers are coming in at this 200,000 new ones at 294, and then you have a 2% bundling increase rate, so that applies to the whole pool of customers they bundle, but then a certain chunk, 16-17% per year, or you do that on a quarterly amount, churns away, and that's what's left over. So that gets you to 812 million IFP, which is where I'm sticking that in for that. And just flip over to the main model here, just to show you, that brings in a premium per customer of 376, which is about a 2% quarter-over-quarter increase. So, which has been similar over the last year or so. So pretty reasonable when you think about the customer increases and the IFP increases. We kind of calculate those separately, and then you have the premium per customer that's popping up there. Now, gross loss ratio, I'm saying 81%. My really rough number is, gross loss ratio excluding cat events is 72%. We're in that range, might even be a little bit better, but 72%. I'm saying, rate increases are improving that. So by about a 3% increase, or 97% sort of factor on that of improvement. And then I'm saying, inflation, maybe we assume that inflation makes it worse by 1%. And then I'm saying cat effects are 10%, say, in Q1, and 2023 cat effects were 15%. Even how, in an interview with Daniel, we talked a little bit about cat events and how they're measured and quantified, and how you can have some variability there, just based on what you define a cat event as. So there's definitely some variability that could just happen just from that. But another great follow here on Twitter, I'll just bring it up, is Prin. He's been posting in the community group. Really appreciate the stuff he's been doing. And he says, he talks about correlations between Progressive and Lemonade cat ratios. And he's thinking, expects Lemonade's cat portion of the loss ratio to be in about 9 or 10 points. So that's sort of what he said. And I think if I go back one layer here, he'd also said he made a similar comparison with Travelers, and the results are similar but a bit worse. Cat portions of gross loss ratio would be between 9 and 14%. I'd be surprised if it's over 12. So he's trying to look at these other insurers, what they're reporting for Q1, and then contrast that with how they've in the past correlated with Lemonade, and see where that could come in at. So then I replied to him and said, it was similar to what I'm showing here in my model. This sort of breakdown is roughly what I'm thinking, is saying, if they're 72% a year ago, we're probably in the low 80s for gross loss ratio. And he's suggesting, I expect gross loss ratio 81% plus or minus 3 points, the cat portion, if it's 8 to 12, so in that range. And then he talked about Allstate as well. They reported relatively low cat. Some crude calculation give me 6.5 eliminated by analogy. So they're pointing to cat portion to be maybe 10%, standard deviation of 2.5. So he's saying maybe 80% gross loss ratio in my model right now. Of course, we could adjust this, play with this, but I have input the 81%. I don't know how. I think gross loss ratio is one of those numbers the market really is interested in. Among these other key numbers like IFP and adjusted EBITDA, but I wonder how they'll react. I don't think it's likely, based on this, that we're going to see like 74% or 3% or some crazy beat. If we did, I'm sure the market would be very positive on Lemonade, but I don't see how that would happen. If they're really bad, like for some reason they're like 85%, 90%, it's going to be really bad. It could be very, very bad for Lemonade, but and for the stock, I think reaction to that. But I really don't think that would happen. To me, it seems very likely we'll hit somewhere in that, high 70s to low 80% gross loss ratio range for record. We were at 77% last quarter, and it even seemed like in last, Q4's letter, they were kind of preparing us for Q1 that, it's going to be a little bit higher. So that would be my expectation. I'd be surprised if it's outside of that, but that's what I'm thinking for gross loss ratio. And then just playing with some of the other numbers here, can I show you guys operating expenses? I have increasing from about 90 million last quarter to 101, 102 million. That's just because they're spending. The other expense lines I have relatively flat, but it's increasing here just because they're spending more on customer acquisitions. That's why you have that increase. And that's why Daniel also mentioned this in my interview with him, that, hey, 2024 is kind of a tough year when you're presenting just the numbers, because they're going to invest more heavily in acquiring customers. So that hurts your finances because you're increasing your expenses, right? But that is the right move long term. I want to continue to see them invest and grow, and ramp up their growth. So continuing to grow and push that customer bottom base of those renters, those pet insurance customers who are going to graduate into much higher IFP later on in their lives. That's the whole strategy. So, but in this year, if you're contrasting it to the year before, you're going to have higher expenses. That is going to hurt your overall numbers. Overall, my adjusted EBITDA is about minus 43 million. It's a little bit worse than the Wall Street analysts' estimates are. A little bit, it's right in line kind of with where they're showing. So I might be missing a few things, or maybe a little bit, who knows, maybe I'm a little bit too pessimistic on a few of the details here, and they'll actually beat this by a little bit. But I would think it would probably be in this range. Maybe it's 40 million if they beat it a little. Maybe it's a few million less, but probably in that sort of approximate range. A graph I wanted to share with you guys as well, when you're thinking about the context of all of Lemonade's finances. I might have to make something like this in my own model here, but Alejandro had shared in the Lemonade group a little thread here. It was yesterday on Saturday, and one of the graphs he showed was IFP versus expenses, and this is all in just dollar values, so not a percentage of anything, but dollar values of IFP. And you see the different G&A, tech, sales and marketing, other insured expenses, different lines here, and it's really interesting. You see, like IFP, if you go back to here, you look at your expense lines from Q3 2021, they're relatively flat. Yeah, they might be slight increases up or down, little changes within them, but quite flat, even though your IFP went from, 350 kind of range to 700 plus. So actually, more than doubling your IFP from Q3 2021. And across that timeline, your operating expenses have been relatively flat. And at one time, it was back in here on one of the say questions I asked about, hey, how are you trying to cut costs, minimize your operating expenses? And Shai had given an answer on that call that, hey, we really think we're at a point now where we're built for scale, that we can aggressively grow our IFP with minor increases to our operating expenses. So you can see this is sort of held fairly steady. I mean, the yellow line we're going to see probably tick up because sales and marketing, they're going to spend more this year. But as a whole, the rest of these lines you should see continue to stay relatively flat, while IFP in my mind is going to double again and double again after that, and continue that process with minor increases in your operating expenses, which that's how Lemonade should have really remarkable operating leverage. They've already shown the market doesn't seem to look at these details or care about these details, but we as investors, if we're thinking deeply about this and watching the real details, these things really, really matter. And this is we can just play this story forward. You double IFP again and then again and then again, and you increase your operating expenses just minor amounts. Well, you're going to suddenly have a very profitable company on your hands. And now briefly at the end here of the video, I just want to share my say questions. If you haven't had a chance to vote for any of the questions yet, please feel free to check these ones out or some of the other ones. You can tell interest in Lemonade right now is not high because only so far far, at least 101 participants, which is very low. It used to be significantly higher in these Q&As. So only 101 thus far. I'm sure it'll grow still, but and only 124,000 shares represented so far as sort of people's voting power, which that's been much higher in the past as well. So interest in Lemonade is, even though in my mind, I continue to accumulate shares and still think this is going to be this is a massive opportunity in my mind. Again, not invested advice, but that's my thinking. Still huge opportunity right now at the prices we're at. And we're just waiting for that rocket ship moment that's going to come at some point. Maybe it's a year away, maybe it's a year and a half, 2 years away. But at this point, when people don't care, that's when I care the most. So, and people watching this, I know you're probably like me, hardcore enough to be actually paying attention, not when just the crowd is paying attention. So anyways, a little rant there, but here's my questions. I asked about Europe. And I said, you launched home in France. It was revealed last quarter 30% of net new customers were from Europe. So how can we think about your strategy of balancing growth between the U.S. and Europe? Are there any unique opportunities or challenges with the European market? This was actually a question I had that I was thinking about asking Daniel, and I did an interview with him, but just didn't have time to get every question I would have liked to ask. But I think it's great because they could really reveal some more info about what are they thinking for Europe and what are pros and cons about that market. Would be really interesting to hear more thoughts on. So, and it looks like it's a good chance this question will get asked. 41 votes, 95,000 shares represented. So, and then in 2018, I said your automation index indicated you managed 2,500 customers per employee. Last quarter, you mentioned 20% of incoming emails are handled by generative AI. Can you provide some current efficiency metrics and examples of ongoing operational improvements? I tried to keep this again general, and then maybe this is the kind of question they might have answered anyways in the letter or the call or given some more details on, but just leaving the door very wide open to say, hey, what are interesting things they could tell us, interesting examples, stories, little data pieces, whatever they are, that could tell us quite a bit more about why that operating leverage that we're talking about, this graph I was just showing you and talking about earlier, why this trend should continue to sort of explode off the page, at least stay flat, would be interesting to hear. And then finally, I said, what are some of the challenges and opportunities for Lemonade with self-driving cars? Are you concerned about the long-term car opportunity in the robotaxi future? And again, this is a very kind of more vague, open-ended question about this, and it's not really pressing to the moment right now. See, I didn't know if I had as many pressing to the moment right now questions, because when I did an interview with Daniel, I kind of asked most of those questions there. So again, you can check out that interview if you haven't seen it, or listen again if you want a refresher on some of those. But this was in light of Tesla and the FSD 12, if you're following that at all, and just the incredible progress they're making with FSD. I've been driving it in my car for this last month here, and really, really amazing. Way better in my market where I live, way better than I expected. And so you kind of see this coming to fruition. Say, hey, self-driving cars are going to be real. They're going to be here one day. So what are they thinking about as management? Anyways, those are some of my thoughts on Q1 and what's coming up. I think it'll be really interesting to see this quarter. Again, I have stock price-wise, who knows what will happen. I think it'll be fairly flat coming in and going out of it. That would be my prediction, but we'll see what happens. So thank you so much for watching. Remember, it's in the bag.